We are live again from CITIC CLSA India Forum, and joining me is India Economist Nikhil Gupta. Nikhil, thank you very much for joining us on ET Now. We are in interesting times globally as well and domestically. From global point of view, everyone is eyeing what the Fed is going to do in December. And from the domestic point of view, the inflation is so low that, now the debate is going to be whether 25 basis point or 50 basis point in December. Right. What's your take?
Right. Thank you very much, Sajid, for having me on the show. So since June, since when we had a 50 bp rate cut by the RBI, which was unexpected in June, we have been holding this forecast that there may still be a room of another 25 to 50 bips over the remainder of this year. So we were clear that there is not going to be any rate cut definitely in August. And even in October, at that time, our forecast was no rate cut in October, and we were maintaining that there is a possibility for December rate cut, primarily because we thought inflation could be lower than what we had expected. And the RBI revised its forecast for inflation lower last time, then we had the GST rate cut, and then everyone revised their forecast lower according to that. And that was one of the primary reasons why we believed that December is going to be a live policy in terms of rate cut, which is still our base case. We still continue to believe that we will have a 25 bp rate cut in December. I understand that after 0.3% inflation reading that we got last week, the noise or the probability of a 50 bps rate cut has definitely gone up, but that is not our base case. We believe there could be 50 bps rate cut, but divided in two policies, December and February. I think it's better to move cautiously, but we believe 5% after 50 bp rate cut, 5% will be the kind of terminal rate in this cycle.
In this cycle means till March 2026?
Yes. In fact, we are not penciling in, as of now, we are not penciling in any rate cut for CY26. Okay. So after February, probably for the remainder of calendar year 26, we'll stay at 5, so a prolonged pause.
Why do you say so that a rate cut beyond 25%, 25 basis points will be pushed to February? There's also the chatter which is there, right? That, okay, we need to push the growth there. Inflation is in control. We have this opportunity now to push growth because not only this year's inflation, but maybe the first half of next year's inflation will be revised downwards, given the kind of what we have seen, the trajectory for inflation. So how do you, do it? And for next year, anyways, the growth target is, which has been penciled by all economists, is much lower than this year, what FY26, what we're going to end with. So why do you say so?
All right. So first, if you look at growth numbers at this point in time, we had real growth of 7.8% in Q1, and we expect it to be around 7.5% to 8% in the Q2 as well, for which we get the number this month end. The RBI is expecting it at 7%. So the growth has been better. We believe the growth in the September quarter is better than what the RBI projected, and inflation is definitely much lower than what they projected. So that is why we believe that there will be a rate cut. Why 25? Because while inflation is much lower, growth is going to be very, very strong in the first half. Now you can always talk about nominal growth rate, which we know is much weaker, and there is a role of deflator because of which real growth is much higher. But I think at this point in time, I would recommend, or I would suggest the RBI to go in steps rather than taking a big leap forward. They have already done 150 bp rate cut in June, and the guidance that probably this is it, we may be very careful in cutting more rate cuts. I think that at that point in time, it worked not in favor of monetary easing. I think it would be better if this time also, rather than doing 15 one go and then telling the market probably we are done, it would be more wiser if we go in steps and keep some room open for probably another rate cuts.
This is chatter that, we need to push our nominal rate to about 10%.
Right.
How do you do that if you are not going to put the stimulus? Because the government doesn't have much of a fiscal room after the GST cut which has happened. They're going to stick with the fiscal glide path which has been articulated. At the same time, you have the states and elections where there are a lot of subsidies being rolled out. So there is a pressure which will be there in the states as well to push consumption beyond a point there. So the only way to do is by RBI, right?
You can say that, but then RBI also has its limits. You would be aware that there is this entire real interest rate, which is one of the way they look at where my interest rate should be. And at this point in time, our forecast and even the RBI's forecast is that we'll be back to closer to 4% headline inflation by the middle of next year.
Okay.
So when they talk about real interest rates, they look at the current interest rates and inflation expectation, let's say 3 to 4 quarters down the line, generally about a year ahead. Based on that, the real interest rate comes out, if I'm expecting it to be closer to 4%, then my real interest rate is anywhere between 1–1.5% at this point in time. I think that is what they're okay with. They would not want it to be closer to 2% or higher than 2%, which will be too tight, and they will not want it to be below 1%.
Okay.
That is why I'm saying 50 bips rate cut is the total rate cut that we are expecting from here on. As far as nominal growth is concerned, yes, we are expecting it to be much weaker, 8–8.5% this year. The government, of course, has done a lot of, has taken a lot of steps. First, at the beginning of this year, they announced much more exemptions in income tax, personal income tax rates. And then GST was announced in August and then implemented in September. So I think we need to give them and ourselves some time and see how these measures actually work out in terms of pushing consumption, spending or growth higher.
So so you started the year with 1 lakh crore government tax rate cut, then you 50 basis points coming from RBI.
100 in total actually.
100 in total, and then you have another 2 lakh crores worth of GST which is coming in. Are you seeing the impact of GST cut in consumption? So
post Diwali, I think it's still too early to find out what is the total impact going to be like, because post Diwali we know data has been really good, but that data is not, I would not take it on its face value, because there are few factors because of which the data has been good. So we know GST rate cut was announced by Prime Minister on the Independence Day.
Yeah.
And since then, it was implemented actually on 22nd September. So we had almost 5 weeks period when probably consumers were sitting on the sidelines waiting for the rate cuts to happen. So whatever we are seeing post September rate cut to the run up into the run up to Diwali, I think it also includes a portion of pent up demand that was there because of probably some slower spending or some postponement that happened during those 5-week period. We have no clue how much was that. And that is why, rather than just looking at how the growth has been in the last 5 weeks or 6 weeks, I think it's better to wait for a quarter. Let this December quarter pass out. I think March quarter, when we'll get the data, then we'll have a better understanding of how much impactful these policies have been.
Yeah, you're penciling in 7.5% for Q2, if I'm not wrong.
7.5%?
GDP.
Real GDP growth. Yes,
growth.
yes.
And that's based on the consumption. But 5 weeks of no consumption, despite that you're penciling in 7.5%.
Yes, because, okay, so again, real GDP, when we estimate real GDP, almost about 40–45% of all the sub-components, we get data in nominal terms, and then we use a deflator to arrive at real GDP, right? Our calculations suggest that deflator will be probably less than 0.5% in Q2, which was 1% in Q1. So when we talk about nominal growth, for which we actually get data and then use deflator to arrive at real, we are expecting nominal growth to be actually weaker in Q2. So it was 8.8% in Q1. We are saying it could be closer to 8% as well in the second quarter. Because the deflator is also falling. Even if deflator is 0.5%, with 8% nominal growth, you can get 7.5% real GDP growth. So deflator plays a very important role.
And how does it play out in Q3 then?
Yes, so that is what we all are waiting. But we got data for October last week for CPI and WI both. Again,
you very surprised by the inflation number?
I was more. I mean, we were expecting close to 0.5–0.6% inflation, turned out to be 0.3%, 0.25% to be precise. WPI turned out to be minus 1.1% again, which was even more surprising. And I'm sure you would know, from the deflator perspective, WPI has a much bigger role than CPI.
Yes.
So I'm worried, because we are expecting some improvement or recovery in deflator going into the second half of this fiscal year, which means Q3, Q4. But we have got minus 1% on WPI, minus 1.1 for October. We need to see how November and December plays out, but there is high probability vis-a-vis a month ago that deflator may still remain very weak in Q3.
Negative, or at least close to zero or something.
Probably. we'll have to revise that data and we'll have to look at what could happen in November and December, because we know there was this exceptional GST rate cut that affected October number. But we also need to be very clear about what was the contribution of food items or the non-GST items.
Especially vegetables, which have been much lower.
Exactly, and that is out of GST.
Right?
So we need to be very clear about what was the contribution of GST in this lower headline inflation, what was the other factors, food items, which are much more volatile. And also slightly going forward, we are getting too much low inflation this past few months, October, November, September. Next, June, July, August, September, October, November, we may see very low base effect, which may push inflation very high.
Okay.
But again,